Everyone, and welcome to this explainer. Look, if you are serious about building wealth, you've absolutely heard these two ticker symbols thrown around. Probably like rival sports teams, right? FXAIX and VOO. People will argue so passionately over which of these is the superior fund. But today, well, we're cutting through the noise. We're going to dive into the actual data to uncover the truth about what truly separates them. And honestly, the answer might surprise you.
Okay, let's set the stakes for this little thought experiment. Imagine two incredibly disciplined investors, and they both have exactly $100,000 to invest. They want to track the exact same index, but they choose different wrappers for their money. Investor A, they put their entire 100 grand into Fidelity's FXAIX. Investor B puts their 100 grand into Vanguard's VOO. Now fast forward through 5 totally chaotic years of market data. We're talking 5 years of unpredictable headlines, wild market rallies, and sudden drops. What actually happens to their money?
The plot twist here is just staggering. Seriously, after 5 years of massive market chaos, just letting that $100,000 ride, the difference in their total returns is literally less than $100. Think about that for a second. We aren't talking about a $10,000 difference. Actually, scratch that, we aren't even talking about a $1,000 difference. It's practically nothing, less than $100. All those heated debates online, all the stress over picking the absolute perfect ticker symbol, and the end result is virtually a dead tie. So with a gap that tiny on a massive 6-figure investment, we kind of have to ask ourselves, did anyone actually win this showdown? Like, is one investor throwing a massive victory party while the other is full of regret? Absolutely not. When the financial finish line is drawn and the difference is smaller than your average grocery bill, it really forces us to step back. We have to reevaluate what we are actually buying when we purchase these funds. Here is the crucial point to understand. Both of these funds are practically identical twins. They are powered by the exact same market engine, which is the S&P 500. This means that whether you buy FXAIX or VOO, your money is tracking the exact same 500 biggest companies in the United States. They hold them in the exact same order, at the exact same weights, and their overall value moves in the exact same direction. They are essentially just two different vehicles with the exact same motor under the hood. The reason their returns are basically perfect mirrors of each other comes down to the heavy hitters, the mega companies, Apple, Microsoft, Nvidia, Amazon, Tesla. Because both funds hold these exact same giants, it explains perfectly why their up years and down years are nearly identical. You know, when Apple launches a blockbuster product and its stock surges, both funds go up. When the tech sector takes a hit, both funds go down. Over the long term, year after year, it's basically a perfect tie simply because you own the exact same underlying businesses.
Which naturally brings us to our next big question, right? If the underlying engine is identical and the 5-year returns are separated by less than $100, what actually is the difference? Why do these two distinct products even exist, and why on earth might an investor choose one over the other? Let's dive into the tiny micro differences that actually separate these two funds in the real world.
Okay, so the first difference people always point to is the fees, or the expense ratio. FXAIX technically has a slightly lower annual cost, while VOO's cost is just slightly higher. But let's do a quick reality check here. On a $100,000 investment, that tiny percentage difference equates to roughly a few cups of coffee per year. That's it. It's actually kind of funny how much time people waste arguing about this specific detail on the internet. It's a fun fact for finance nerds for sure, but practically speaking, that tiny fee difference is absolutely not going to make or break your wealth. It's simply too small a matter.
The real nuts and bolts differences lie in how they're structured. FXAIX is a mutual fund. It prices just once per day at the market close, and it's incredibly common in retirement accounts like 401ks because it's fantastic for automatic investing. VOO, on the other hand, is an ETF, or exchange-traded fund. It trades all day long just like a regular stock, giving you a bit more flexible buying and selling, plus it offers a slight tax advantage in standard brokerage accounts. But the honest reality? If you are a focused, long-term investor, this structural difference barely changes a single thing for your overall wealth. So neither fund actually wins. They're just different clothes on the exact same product. They aren't rivals at all. If neither ticker symbol is the champion, well, who is? The real champion of this explainer, and honestly of your entire financial journey, is time. Time in the market is the undisputed heavyweight champion here. We've got to stop worrying about the packaging and start focusing on the incredible power of letting your money sit inside that S&P 500 engine for decades. This is where the wild power of compounding comes in.
Let's say you invest that $100,000 and you just leave it alone. No trading, no stressing over tickers. Assuming a historical average return of about 10%, in 10 years it grows to roughly $259,000. In 20 years, it's nearly $672,000. And in 30 years, your initial $100,000 has ballooned to roughly $1.7 million. That is the sheer magic of compounding at work.
Now, I know what you might be thinking right now. Well, that's great, but I definitely don't have a massive $100,000 lump sum just sitting around to start with. And hey, that is completely understandable. But don't worry, the math of compounding doesn't require you to be rich on day one. In fact, the strategy for everyday investors is arguably even more powerful because it relies on habit. You can totally still hit that magical seven-figure mark. By investing just $500 a month consistently into either of these funds, you can reach over $1 million in the long run. Think about that, just $500 a month. You don't need a massive windfall, you don't need luck, you don't even need to perfectly time the market's ups and downs. All you need is consistency and the patience to let compounding do all the heavy lifting for you.
So, to help cure any lingering analysis paralysis you might have, here is your final, pragmatic verdict. Choose FXAIX if you already invest with Fidelity, or if you just absolutely love the set-it-and-forget-it nature of auto-investing in a mutual fund. Choose VOO if you prefer the flexibility of trading it like a stock, or if you use brokerages like Vanguard, Robinhood, or Schwab. It really is that simple, folks. Pick the wrapper that best fits your current brokerage setup and your own personal investing style.
Ultimately, the bottom line is that we've got to stop overthinking the wrapper, because as we've seen today, the specific fund matters far less than simply starting early and staying invested. The single most important question you need to ask yourself is this: am I actually investing consistently? If you can answer yes to that question, you already understand more than most people in the market.
Now, I want to help you turn all this knowledge into immediate action. If you want to start investing in the US stock market, but maybe you don't have huge capital up front, you can use a platform like GoTrade. It actually allows you to start buying fractional shares of massive companies like Apple, Nvidia, and Tesla with just $1 single. You can set up your account and literally start building your portfolio from scratch in less than 10 minutes.
To make it even easier, you can grab the referral link heygottrade.com/referral, code equals 386990. Use that code to set up your account today. Because honestly, whether you have $1, $500, or $100,000, the most crucial step is simply getting off the sidelines and getting your money working for you in the market. As we wrap up this explainer, I'm going to leave you with one final, vital thought to ponder. Now that you know FXAIX and VOO are essentially the exact same incredible wealth-building engine, are you going to keep stressing over which wrapper to buy? Or will you make a decision, stick to it, and let time start building your wealth today?